All right. Good morning, everybody. So we have another day of Powell. He's going to be chipping his teeth again. And other than that, we're all just watching the headlines. Um, I think the most telling thing that we got was spot gamma and the foot wall being rolled up. They just came out with the AM edition. That's why I started a little late. I was getting that downloaded. I'm throwing it into the chat now. So you guys are going to have a chance to take a look at it before me. But that put wall being rolled up carries more weight for today than anything else we have on the table today, at least with the economic agenda. Japan, a little bit of a rebound from yesterday, up a half. Dow flat with the small caps. Tech up 0.25%. The S&P kind of somewhere in the middle of that. So they're not running in sync. The algos aren't swinging the hammer at this point. It is Wednesday, so we're going to get crude stockpiles. That's going to be a significant change. It's worth keeping your eye on the clock for this one, 10:30. And of course, we got another auction in the front end. I'm not really interested in the 5-year note. It's like one of your cats or one of your pets, right? You're not going to ignore it, but it may not be your favorite. So when I noticed the foot wall had moved, I took the opportunity to use Spot Gamma and their tool to go back and plot where the foot wall was. Right, it's just a function of their website. You can, if you have a sub there, you're able to plot out the call wall, the foot wall. I could have put all of them in there if I wanted to with price. The thing is, if I'd have put all 5 of them in there, then it would just be a spaghetti of lines all over the place. So I just showed the calls and the puts, and we can see that the puts have rolled up significantly. By itself, that's not going to give us very much. We had the same maneuver happen back here, right? The puts were rolled up and the calls didn't get rolled, and they ended up rolling those puts right back down again. Or back here, for an example, where they rolled the puts up and the calls rolled up with it, and then they dropped the puts back down, but the calls didn't drop back down. We held the line for a while, and you get the idea, right? That this one singular thing all by itself, not enough. It's just another piece of the data. Okay, so at this point, they rolled the puts up. That creates a little bit of a pinch and it puts everything really close together. The expectation is that, like a squeeze, it's going to force something to move. It's not guaranteed that anything moves at all other than the wall itself. Tomorrow we could get in here and find that they rolled the put wall right back down again, just like they have done previously, right? All these different times that they rolled it right back down. Or they could move the call wall up, or nothing can change. We could come in tomorrow and it just stay in this really tight squeeze that we're now presenting. Squeeze isn't really the right word for it, but it's the best I got it this early in the morning. So, just take it with a grain of salt. It's just one data point. And by itself, it don't mean jack. So we want to take that and, tie in all the other parts and pieces. We did leave zero gamma behind by a considerable distance. We are getting a bit extended from the 10-day moving average. We've got the volatility trigger with us, and we are pressing that call wall. So one of the things I want to see throughout the day today is that call wall being moved. Yeah, you kind of need some options tools for that, unless you're just going to go in and stare at the SPX options time and sales. You could certainly do that, right? And filter it out and try to look for that to get moved. You could do it in the ES too, but once the market opens, you're better off going to the more liquid product, SPY, SPX. So I'd want to see that call wall start to get rolled out, and or I would want to see indications that that put wall being rolled up is getting unwound and that it gets lowered back down again somewhere else. We are doing pretty good when we consider, if we're in positive or negative dealer gamma. This far above the zero gamma line, we're in a pretty comfortable position to say we're in positive dealer gamma. Now, this isn't really the forum for it or the right chart for it, but think of these zones where we can go through positive and negative gamma, even though we are thoroughly above the zero gamma line. If we were below that, we would be in a heavy negative gamma. We're above it, we're in positive gamma. But even with that, there's these zones and levels that we go through where we are positive and then negative and then positive and then negative and then positive again. And we transition through those zones through the trading day, through one single day. That is different than using these lines and levels that are focused on more of all of the options, not just the 0-day gamma levels. So it's a mixture of multiple things, right? Above this zero gamma line, especially this far away from it, we have some inherent ideas of what price should do. If we break out and run to the upside, we expect dealers to sell into strength. That's just is what they do, right? It's not because they want to manipulate price or because they want price to do something in particular. They don't really have a need or an ask out of price. They don't care. All they care about is hedging their position. How much risk can they offset? So as we begin to run up, they're going to sell into that strength. And that's why in a good bullish market backdrop, we have decent small candles and we don't have big giant ranges and we have a small ADR, right? Because we have all of this selling into that strength, and it stops us from making those really big day-to-day moves. So you want to lower your expectations on how far a market can go on a day-to-day basis, as long as volatility is low and as long as we're still above this zero gamma line, especially this far away from it. Once we get near it and we begin to cross back and forth through it, then those dynamics and our expectations of how dealers are going to behave, well, then that has to change, right? Because then we'll be crisscrossing back and forth through the zone too much. Now, don't get me wrong, we're still in a precarious situation. We still got a lot of bricks in the wall of worry. We got a lot of unknowns. So we could easily trigger back into high volatility situations. But if you look at the way things were back here, big fat bars, wide days, very wide ADR, these are situations where we're in a negative dealer gamma environment and they buy into strength. So if we break out, they buy it and we get these really big bullish bars in a bear market. And if we break down and we begin to sell, they sell into it. Right? They will sell into selling and we can fall really far, really fast because they're exasperating the situation, making it worse. That's why bear markets have some of the biggest bull moves in the history of bullish markets, right? Because when we're in a bearish situation and we break out to the upside, dealers will buy into it like crazy. But we're not in that environment. We're in a positive gamma environment. So breakouts like yesterday generally don't stick, right? They don't get us very far because dealers are selling into that. So when we look at yesterday's move and realize that we are in a positive gamma environment. Even with the dealers selling into that, we just kept right on going, and we kept it up there at that 6150. Is pretty good. It's impressive. We didn't give it back. So that's a good start, right? Keep your eye on that call wall, see if it gets rolled out today. Look for indications that they're moving the put wall back down. We got overnight volume of 50,000. It seems a bit light after the 100 plus that we were getting in the last few days. Half as much volume, right? And that's because we really don't have anything this morning. What do we got? We're waiting on headlines. We're not expecting anything out of Powell, right? It's going to be another day of don't rock the boat. Open his mouth and say a bunch of things that don't mean anything. Now we're basically flat at this point this morning. So we have no edge to go to one side or the other by the end of the day, just judging by price action alone. Now, having said that, we can get to the lower edge easier than we can get to the upper edge simply because we would have to break out of our own price action of yesterday to reach this point. So we would need an inside day breakout to get to the upper edge. We don't necessarily need that to get to this lower one. Sure, we have to break the RTH, but it's not the low of yesterday. Yesterday's low was off the charts, way down here somewhere. So we would need a RTH inside day breakout, but not a full inside day breakout. So we can get to the lower one easier simply because there's less pivots in the way. But it doesn't have to go to either one today. These two red lines are the average daily range. So that's what our expected movement is for the day. But we can manage to go through the entire day without hitting either one, especially if we don't have a catalyst to fuel the push to make us move. We are at that big options level, 6150. So it's going to be the key level right now. And if we can get out of this very narrow initial balance, then the target will be yesterday's high first. Get through that, we can focus on 111, 1236. If we can get through those, then we have 6184 and 6192 cog line. It's way up there. I still like 6200 this week if we don't start to unwind. And so far, we're not doing it, right? We're just keeping it and keeping it and keeping it. Two ways to measure the topside breakout with the 111 and the 1236. This is using just the RTH. And of course, we can use all of yesterday, not just the RTH. I generally use just the RTH first because it'll give us lines that are closer to price, and the distance that price has to move is often less. In a positive gamma environment where we just discussed price doesn't make as big a moves as it would in a negative gamma environment, you don't want your lines too far apart. Having said that, though, knowing where the other set of lines are is helpful. We can see that the 111 for the entire day is somewhere between the 111 and the 123 of just the RTH. So it just provides a little bit of insight. But the main focus would be if we can get out of our own range, which we're working on, then we target yesterday's high. And if we can get through yesterday's high, we've got a 111, 1236 situation. Same thing will go for the other way around. If we do happen to have another fake breakout like we did on this wick here, and we retest the low, break the bottom, get through our own Globex low into the half, get through the half to focus on the RTH low. There's also a 6132 cog line, which is the half, and 6111 cog line, which is basically yesterday's low. If we can get through those, then we have the ADR half, and then the round number 60 100, and then 6092 cog on down, right? On and on and on until you get to the lower ADR. So no matter what direction we run, we've got the levels to play. There's your downside, 111 and 1236. All we got to do is get out of the box, right? It's the second day in a row where we have not hit our daily floor pivot. This is a MDP, missed daily pivot. The expectation is that price hits its pivot because, well, that's generally what it does. We didn't hit it yesterday. Today's pivot is higher than yesterday's pivot. That's bullish. Price opened above today's pivot. That's also bullish. But we're on our second MDP. The one that we're building now won't count until tomorrow because we have to make it through the entire day without hitting it before it counts. But the one that we built yesterday where we never hit it, that one counts for today. So we've got one and one in the works. Because of the significant move in price yesterday, today's floor pivot SNR levels are going to be farther away than they were yesterday. All right, so just to kind of put that in context, going to get ugly here for a moment. After really wide days, you can see how the distance between these lines are very far apart. Right? You got something like that compared to a day where it's really narrow, like back here. You see the difference between those two boxes is significant. So how far price moves in the previous day really has a toll on how far apart your pivot levels are in the current day. If we get that breakout of yesterday's high, we've got the R1 6174. One of the pivot strategies is getting to R1 and then rejecting and getting to S2. That would be a bit significant on a day like this. We'd very likely need some fire for that. Headlines people didn't see coming, a little bit of shock and awe. And of course, we can't predict that because we're talking about some unknown event hitting the market that we didn't see coming. So unless we get some kind of shock and awe surprise, going from an R1 to an S2 really isn't on the table today. But that is a setup that we have available. Otherwise, it'd be getting to R1 and then getting back to the floor pivot. If we don't manage to get this breakout and we don't manage to get to R1, then failing the breakout, we'll target the floor pivot. Get through the pivots channel, get to S1. The strategy works the same in both directions. If we get to S1 and we can get back above the floor pivot, we'll target R2. It's kind of hard to see it getting all of that today. It'd be a considerable run, but we've had those kind of headlines lately that can really gyrate price in the short term. So why not, right? We had the same kind of maneuvers yesterday where we were high and then we were low and then we were high and then we got even higher. So it's absolutely possible that we can do the same thing today. Get to the S1 and get to the R2 by the end of the day. The same maneuver as yesterday. The idea is while price can do whatever the heck it wants, how likely is it that we get an S1 and R2? Not very likely. Same consideration for an R1 and an S2 at this point. It's absolutely possible, but it's not likely without headlines. After weeks of this very narrow sideways range, this week's breakout range really stands out. Now, the classic distribution from, like mid to late May, and the more shunted ranges since then, and then now this big breakout play, watching for the value area low to get brought up into that 6100 area. Be a nice tell to have everything tighten up, and it would really validate the distinction of the two different zones that we're working with. We got the zone above 6100, and then we've got the zone below 6100 that centers around the 6050 area, which is our line in the sand, right? We're going to go from 6150 to 6100 to 6050, then to 6000, 5950. You kind of get the idea, right? That's why those big 50 levels are so important. Of course, the options flow and the point of control and the volume profiles tend to validate that as well. So $10-day, 30-minute volume profile and TPO. The TPO is really not reflecting this work that we're putting in across the top, but the point of controls are lined up relatively well. The value areas also far below. We are significantly extended beyond the zone. The idea is that we got to keep it, and everything's really narrow or shallow up here. We don't have any structure underneath this, just simply because of how fast we got there. So we need to put in some work. If we get outstretched too far too fast, then we got, really thin levels underneath this, and we're going to dump it and give it all back. We don't have a new VPOC this morning since we've been chopping in this narrow initial balance that we're finally leaving. An initial balance that's really narrow implies that there's still a lot of work to be done, and that even later in the day, we can actually get a move on because we haven't had the move yet. So getting out of that really narrow initial balance is a good step. It's a good start, but we need to continue on with it. So no VPOC from yesterday. If we do break down through 6100, we've got one at 6066 at the top of that bull flag from Monday. Testing the edge of the weekly expected move again, and testing yesterday's high. Statistically, we're supposed to close within the range 70% of the time. That's a 1 standard deviation mathematical formula. The S&P has the most accurate expected move model out of any options product available, for a lot of reasons, but it's just the way it is. So instead of 70, it generally hits around 80%, which means if you count back 10 weeks, you should find that price closed within the box at least 7 out of 10, if not 8 out of 10 of those weeks. It's a real simple way to just do statistics, right? Or percentages, I mean. Well, if you was to count back the last 10 weeks, you would notice we're not hitting our 70 and 80%, which is a warning. It's a tell that volatility is not being priced into the market and that the market is exceeding its expected move model. So that is a warning to us, not to trust these weekly expected move ranges, because they can easily be broken, like we broke it here on a Monday. And by the end of the week, we had nearly doubled the range. So we are outside of it. If we can get a breakout of yesterday's high, we could, at the very least, expand the first half higher. The gray line is Friday's close. The green line is how far we should have gone to the upside on a bullish week. That gets us to 6250-ish by the end of the week. if we were to do that, we would get a bit extended above that 10-day and 10-week. So we are at 4% above the 10-week. This is getting a bit stretched. It's not as bad as it has been in the past. If we were to draw a line there and look back, we've been higher than this above the 10-week moving average. So this isn't as bad as it could be, but we're getting there. So when we think about, hey, did we move too far, too fast, and does it owe us any sort of pullback or mean reversion? On the weekly, not quite, but it's really close. Look how often we got above that line and actually stayed there for more than a day or two. We had a little bit of that back here, right around December 2023. So it's possible to hold it for a little bit. More often than not, we pop above it and we drop right back down. And if you look at how far that drop is, where we, maybe got into 5.5, and then we were down 1.5%, then we were down 4% in a single day. It's a significant change in a 24-hour period. So we can cross that line back the other way fast. And if you're thinking about swing trades short term, and maybe using July expiration on the monthly, what's more likely? That we go 4% higher from where we are right now? You're talking about 8% away from the 10-week moving average. Technically possible. Or that we go back to the 10, which is a 4% drop from where we're at. I mean, statistically speaking, it's more likely we drop 4% than we rise another 4%. So if you're looking for some short-term trades, the odds are on your side to go short rather than long. And if you buy those puts or put on the short trades while we're still rising, you'll get a better price for them. So that covers the weekly. We're not quite in that negative zone where we expect it to mean revert, but it's close. Now you look at the daily on the other hand, and we're just towing the line here. We're not overextended. We're not overbought. We're not overstretched. It's not moved too far too fast. Doesn't owe us any sort of mean reversion or pullback or least squared method or anything else. So while we could fall back 4% and hit the 10-week, this says, why would we? There's no reason for us to be reverting back to the mean at this point, because we haven't gone too far too fast. The VIX is down 15% over a 5-day period to more than 2.25% this morning. And really, the VIX is the only thing that we have this morning that's down. If we look at what's up, we got Bitcoin and more Bitcoin, more Bitcoin, and a little bit of Bitcoin. China, chips, Mag 7, tech, Mag 7, China again, uranium, but now we're below the half. Chips, China, and Bitcoin is what we have up this morning. It's in the right space. Chips can get us going. Mag 7 can carry the rest of it. So we could get like a 0-day drive. We just don't want to get back in that situation where the Mag 7 is carrying most of the market. All right, it shows that healthcare is down too, but it's just an algo print. We want this to fill out a little bit before we start to think that healthcare is going to give us something to the downside. And the same with nat gas. I mean, nat gas is a bit of a joke anyways, but at least it has some candles to it, right? And it's down, but it's trying to bring that back. This is, the idea of why is it a joke? classic bear flag, though, all things considered. So it's all Bitcoin, crude. We got expanded tech moving around a little bit. It's just an algo print at this point, but watch Cloud, CLOUD or CLOU. There's no D on the end of it. That ETF doesn't do good in the pre-market, but it often will move because of IGM also moving, right? So once we get into the open, think of the names that are within the ETF for cloud or expanded tech. Some of them are the Mag 7. Could tie in to fuel the move. Now, even though we're not expecting anything from Powell, the market very likely will wait on him before it does anything else. It doesn't have to, right? We didn't do that yesterday, but just be mindful of the fact that we could get into the open and just sit and spin waiting on Powell to get done doing what he's going to do and then make a move. I think this rejection is going to come before that. I don't think it's going to wait, but so it's a really simple layup today. Get out of the box. This is our Globex box. Get out of that to do anything else. If we get out of that and we get an inside day breakout, I would expect the reversal, the 111 or the 1236 off the top. If we manage to push through that, then I would continue to target the upper ADR lines and run it for everything it's got, because that's what we've been doing, right? If you look at these last 2 days, certainly went further than I think anybody else expected. And it's not the first time, and we've been doing this. So if that's what we're going to get, let's do it. No reason to fight it. But we are stretched from the 10-week. So if you're thinking about a swing position short term, the odds are that we, fall rather than rise with a target of 4 to 6%. That's what I got for you guys. Be careful, be safe, watch the clock. I'll see y'all tomorrow.